Welcome back to smarthelping.com. I've got a pretty intricate model here. It involves acquiring retail locations or building retail locations and then scaling them up. And there's slots for up to 25. It is expandable. It'd be kind of difficult, but you can expand it if you want more locations. All the logic's there, you just have to drag the formulas. But what I really want to talk about is what all this logic does because there's a lot of advanced and dynamic stuff here that I think is pretty innovative and I've never seen it before done like this. These it's usually hard to figure out dynamic ways to build scaled out systems. So let's just look at really basic here before I get into the model. So let's say I know I'm gonna go and acquire 10 locations or build out 10 locations of, let's just say, it could be restaurants, or it could be basically any retail location that sells anything uh, whatsoever in any industry. Uh, could be pool supplies, uh, home decor, um, just a home goods store, anything. So here's the problem. So you want to say you are going to have potentially different months that each one is acquired and begins. There's a cost that goes with launching each one, and then you want to say that um, there's a starting capacity that you can do for each location, and a percentage of that capacity is reached and I've done it over the first 12 months to define like the basically the location, growing customers, getting awareness, all that stuff. So that's dynamic. And then you have growth after that. So you have the starting max capacity, but then that can grow each year after the first 12 months. So how in the world are we going to do all of that dynamically? Well, let's get into it. So I'll go through every single tab, show you how all the logic is running, and you can see how this is going to work. The first tab is just general environment specs, like the start month. This is going to define the 5-year period that your forecast is going to go to. The exit month, if applicable, right now I have it as NA, but you can set it as any month. And the exit multiple, which is going to be based on trailing 12-month EBITDA. So it's going to take last 12 months, including the exit month, and then times that by this multiple here to get a value. Um, let's just put one in here just so you can see it. So exit year 5, 84 million is the multiple. Then you have debt proceeds. So if you want to fund your business, you can borrow money from a bank. Also, you can raise money from investors, which you can define here. They get a share of the company, implied valuation based on that. Then any remaining cash, so you see we needed 12.9 million, which is going to be based on essentially the total negative burn, including startup costs, is this number. And that is going to include acquisitions as well. Uh, any cash that essentially is available is going to be going to that, and anything that's not, any month that has a um, negative cash flow because of acquisitions would go toward this amount if it wasn't covered by other positive cash flows. And we'll get into all that at the end for distributions. Investor proceeds. So yeah, the owners have to pay whatever's left. So if you need 12.9, you can only raise 3 million. You're going to come with this. Let's say you can raise 10 million, and you only need 2.9, or you need to borrow money. So maybe you raise some from a bank, and now you only have to come up with this much on your own. Now, if you can cover it all with debt, and or investor proceeds, then you don't have to come up with any money up front. It just depends on your situation. Corporate income tax. We're gonna get do a little bit into taxes, but it's not a huge part of this. But I have put in dynamic logic to figure out estimated kind of what your taxes might be. Okay, so now the fun stuff. Capacity matrix. So here you go. You'll name all your locations here. Everything in light yellow with blue text is editable. Start month is dynamic. Um, Percentage increase in capacity achieved. Now you can use this. You don't have to. So right here we just have month 1 to 12, and this is dynamic. So whatever the start month is month 1 for each location. So you want to say what percentage of the capacity are you going to achieve in that first month, and it could be 0. And you honestly, if you acquire this, the cost to acquire is going to happen the month prior, and then month 1 after, and then month 1 is going to be here. And if you don't think sales are going to start for say 7 months, you could literally just put 0% for the first 7 months, and then month 8 manually put in whatever percent. You don't have to go with these formulas. I just put them in here to make it easy if it does apply to your situation, but it might not. And that's either way, it doesn't matter. You just have to get the percentage in here that makes sense for your situation. I'll put in some, green. That's just going to give you a dynamic thing. Like if I change this to say 10, 5, 50, you can see how the numbers, say I put 0, and then so say overwrite some formulas here. That's completely fine. Then after, whenever it starts, it's going to start at that amount and then increase by um, whatever percentage is here. So, or I'm sorry, it's going to start at whatever percentage, so 0, 0, 0, 0. Then finally, the formula kicks in. We're going at 10, and then adding 10 to that every month. And obviously, the max will never go over 100%. Let me undo all that. These back to 20. I just did them all the same, but they might not be. You might have different locations that you think will scale up differently. They might scale up quicker or slower as well. Then we have, so based on all of this, we know what capacity is going to be reached in the first 12 months. Then after month 12, it's going to assume whatever the max capacity is being reached. And you can see how this revenue number is increasing each year. And let's now get into in tickets per day, but this is all based on the matrix. We'll have to get into this in a second. But once you have this built, go to the revenue assumptions. We now have each of the 25 locations listed out here. And then you can define up to 3 different ticket values. Now you might have, one ticket value and say, well, 100% of people spend on average this month this much on a ticket, and there's this many tickets a day. So if you were doing that, you just put 100, 0, like that, and I just put all these as formulas to equal this, so you only have to change this to get all of them. But again, you might have different locations that have different ticket values, and a ticket just means like the invoice value or whatever on whatever you're selling. It's the price of whatever you're selling on average, and usually, like if this was a restaurant, you could say this is the average value for takeout orders, this is the average value for dine-in, and then you wouldn't really have a third one. But if you're doing something else, and you have 3 different tiers of things you're selling, then this will be important to have for you. But if you zero anything out, it's completely fine. So this is how we figure out the starting max capacity, and then based on our capacity matrix, it's going to tell us of that how much are we achieving over the first 12 months after opening for each location. So average ticket value, ticket capacity per day. We have the days per month up here and the capacity growth up here. Now this capacity growth is going to take the max capacity after month 12 and then do it. And obviously locations that don't start until year 3 are never going to see a year 5, which is completely fine. And that's why it's dynamic, and that's why we have to do all this in a complex way, because there's you have different locations starting at different times, and you need to know what life cycle that location is in, and it's going to be different than any another location that might have started later or earlier. So we can target this range based on the year, and we can base the year on the location life, which is going to be in the matrix, which will go into those in a little bit, how I defined all of that. It's very advanced stuff, but it's super useful for this kind of work. Any kind of scaling operation of a retail business, this will be helpful. So ticket makeup, then you can just do a simple multiplication here to figure out your average revenue by type, total revenue per month, and then we also have for each location its acquisition or development cost here. And it's always going to assume that this cost goes out 1 month prior to the start month. And again, like I said, now you can see why it's important to be able to modify these percentages as needed, because it might take 4 or 5 months to develop. It might be ready, you might be able to acquire it, and then sales start the next month, but they might be low, which is fine. You can start it low and increase it at whatever rate you want. This just does a monthly amount fix, but you can change these percentages and overwrite it as needed. All right, so now we see how revenue happens, how growth happens after your max capacity is reached. And the way capacity can grow, like might wonder why you hit max capacity and then that actually can rise. Well, it could happen for a few reasons. Mainly, you might become more efficient, so you can just do more over time after running a location for a year or 2 or 3. You might be able to do more tickets, because that's essentially what's being driven up is this right here. This daily amount is going to be this percentage is basically applying to that. We're assuming the price is the same of the average values, and the percentage makeup is the same over time for each ticket type. So that's all dynamic. And wait till you see the matrices that I had to do to make all this work is crazy. So all right, labor costs and goods sold. So here we're trying to say each location in its first 12 months, this is how it scales up for the number of laborers that it needs. Now you could do a different scale up for each location. They could all be the same. Right now, I just made all these just go to 15, and then that's what it stays at for that's its maximum laborers needed. The average hourly rate for each laborer, and that's fully loaded, so that means you need to include not just their rate, but benefits and payroll tax, all that stuff. So typically that means you're going to want to double it, roughly whatever their actual rate is, and that'll give you a pretty conservative number. Then you want to do the average hours per week, and then based on that, we're going to dynamically know what we're paying our laborers every month. And you can grow that at 2% or whatever percent. That's essentially just to assume rates are going to rise over time, most likely. It's not really to try to account for adding any more laborers than already exist. You're just trying to say the rate could possibly go up, so we have to increase it over time. Um, and all this is all going to be dynamic within the life of each location. Then here we also have cost of goods sold, which we're just defining as a percentage. And then based on whatever percent cost of goods sold are, we know what our margins are for each type of ticket. And then also one of the startup costs is going to be inventory. So we want to know how many months we're going to buy inventory ahead of time. If you put 3 here, it means you're going to buy whatever inventory or whatever the cost of goods sold are for the first 3 months, you're buying there. And then after that, every 3 months, you're going to be buying inventory. You can see the inventory matrix is here. So since we had 3, we're buying month 1, 2, and 3 inventory, and that cost is going to go in month 0, but it's not going to show up on this one. For the first month, it's going to show up automatically right on the monthly summary right there. So that's the first month 1, 2, 3, and then 3 in theory we would have run out of inventory. So we need to purchase more in this month because we know in this month we're going to use up everything we had bought. And then that purchase will then last another 3 months, 1, 2, 3, and then we'll buy more. and then I'll last 1, 2, 3, then buy more for the next 3 months, and so on. And you could change this. This could be 2 months, and you can see if we go back to the monthly, now it's every 2 months. Or it could be 6 months, which would be kind of crazy, but whatever the case. And that is going to, because when we do the cash flow, we're going to add back the cost of goods sold and remove out this actual inventory purchase amount. So we get the right amount of cash flow and the timing of that, which is usually important in retail businesses that have to keep inventory or have to buy inventory ahead of time. That's going to be a cash requirement um, that you have to track, especially while you're scaling up. That's important to figure that out. All right, so that's that. Then we have our fixed costs. Now this is probably the most basic of all the logic. It's just I put in like 100 and some fixed costs. You can determine different start months for everything, and then you can put in what the monthly amount is over each of the 5 years if applicable, and that's just going to automatically go over to the monthly operating expenses. So our main variable stuff that's complicated is going to be labor, cost of goods sold, and revenues. Fixed costs are pretty simple. Startup costs, this first row is always going to be for inventory, so don't ever change this. Don't change anything on here. This is all happening dynamically. But you can change from row 5 to 20 to whatever you think you're going to need for startup costs outside of inventory and outside of development or acquisition costs. Then CapEx is another thing where it's essentially the same as startup costs. No, I mean, normally CapEx is going to have depreciation, which I have done a depreciation row, but I haven't made it dynamic, so it's just going to have to be hard coded. If you do have depreciable things that you're buying, they would go here, and then the depreciation for that is going to be put in here. But just so you can get the right cash flow, um, I've put this, made it dynamic based on the start month. Um, all right, so those are all the assumptions. Now, I'll briefly go over how those things actually make this work. So let's look at matrix 1. So this is activity scaling, I'm calling it, and essentially we want to know, number 1, based on all those variables for each location, what is the start month, and then how long has that location been active since that start month. So all it does is it figures out based on what's entered here when to start counting, and then it just goes and it starts counting 1, 2, 3, 4, etc. all the way to the last month of the forecast, and you see some make it to year 5. This one only made it to year 3 because it didn't start. That location wasn't open until January 2023. And that's just based on this right there. And you see, if I change it to February 2023, now it's not open until February. So this is all dynamic. It just figures out that start month and starts counting forward. The next part of it is the active year. So this, you do a little bit of a division problem, and you can figure out, based on the month in existence, what year is it of the life of that location. 1, 2, 3, 4, 5. And based on that year, we're going to be able to go back and look up the revenue that should be that should exist for that year. And year 1 is going to be different because it's a percentage. So we're actually going to, so we know this is the max capacity, but we're not going to reach max capacity on most of these at the beginning. So how do we do it? Well, we also have a dynamic array or dynamic matrix for the percentages. So this looks at each location and figures out based on the month of the life of it what percentage is at. So here you can see each one starting as 12 month start here. So 20, 30, 40, 20, 30, 40, 50, all the way to 100. Then once it gets to 100, it goes to max. So when we're trying to figure out the revenue, we look up the active year. We also look up the percentage that it should have been attained. Obviously, anything over the first 12 months is going to be 100%. But if it's before that, it's going to be a percentage of, and then something whatever the values are for the first 12 months based on the max capacity in the first 12 months. What you can see, this is just doing an index on the revenue assumption, just essentially looking up this value because we can calculate it here. We say that's the max it can do in a given month, and based on that, how much revenue is going to happen per the capacity. So there's a lot of lookups. I try to use indexes because those are the least likely to break if you start messing with things. But so that's percentages. The other part of the first matrix is going to be labor costs. Since we want to scale also the labor from month 1 to 12, I had to figure out um, this is a big long formula, but essentially it figures out when the start month is of the location, how many laborers are there for that month 1 through 12, and then if it's after month 12, it's just going to assume the max laborers that exist, and then take this whatever value is the max for each year. So it doesn't need to, it is starting all automatically assuming 15, $30 an hour, 35 hours a week. But then, and based on that, it'll go up in year 2, 3, 4, and 5 dynamically based on whatever year the location's at. So you can see once these all get to max scale, they're going to get to 73, 876, and some of these never haven't gotten to year 5 yet. So that's why they're different values. So this is why it's not easy to make these things dynamic. It takes a lot of logic, but it's super useful if you do it. Here's the head count, so you can see that counting up 5, 10, 12, 15, and that's going to be dynamic based on whatever is put in here. I put them all the same, but like if we put this at like 2, 4, 6, you can see I can go back into here. Now look for location 2 is 2, 4, 6. And then I can also figure out based on that how many hours exist. So this is how I get, I look up the head count times the hours, average hours for each location to figure out total hours. And then I can back up into a labor cost based on that. And there's a lot going on here. I had to go through and check all of this insanely in a very specific or very detailed way to make sure nothing is wrong and it works perfectly. But it took a lot of testing, let me tell you. All right, so there's that. Anything else on Matrix 1? The head count, labor hours. Nope, that's it for that. Matrix 2 has, now what I did on the monthly, because I wanted to do a separate cost of goods sold for each type, I actually had to go and rebuild the revenue in a different way using the same logic. So you can see if you look at the P&L monthly, we have total ticket revenue here by type. We also have it by location here. And these numbers are going to be the same, and they're not double counted, obviously, when we figure out our total revenue. I just use this one when I figure out gross profit. But that's how I checked the calculation because it was so complicated, and I got to the same value, which is good. But I used different methods to calculate it, so we can show it by type and by location, and they're the same. So that's what Matrix 2 is for. So we had to figure out what's the ticket sales count for type 1, type 2, and type 3, and that's going to be based on the total tickets per day and the percentage per day, or percentage of those sales that are type 1, 2, and 3. So that's all Matrix 2 is, and then Matrix 3 is figuring out the cost of goods sold. So this is then looking at the ticket counts, figuring out what the value is, and then actually multiplying it by the labor cost of goods sold to get cost of goods sold. And then how we backed up into, this is cool. So how we backed up into sales is dividing the total matrix amount for each type per month by the labor and cost of goods sold assumption to get the total revenue, and that backed into the same number here. So that was how I did my check, and it was actually useful because I need to get all these values anyway. All right, so that's matrix 1, 2, and 3. Next, so distributions. This is just going to show the cash returns, cash outlay, so all positive cash flow months, all negative cash flow months. Then you can see how much equity was required, how much was available after the startup costs were applied. So 10 million, and then you can see the usage of that in these other negative months. And these negative months are saying you had inventory purchases and acquisition costs that took away. So even though you had positive cash flow, you had negative. The negative was covered by just barely enough. There's only 195,000 left after this. So you can see we got to keep all the positive cash flows because we covered all these outlays. But then in the next month or next year, we had 14 million in positive, but another 12 million in outlays, and we have hardly any equity left to use. So this is now pulling from these positive cash flow months to pay for the acquisitions. So now, after everything's said, now there's only 2 million to actually distribute. So there's a big difference between the amount of positive cash flow months and the actual amount that can go out because you're doing inventory and a lot of other things. Um, and so this logic has to be used to figure out what's actually available and what's not available. And then as you scale up, the numbers get bigger. You've got more, your revenue becomes higher than the inventory needs, relatively speaking, and you start being able to make more. And then we've got an exit happening. Or did I remove that exit? Yeah, we do exit here. Now if I remove that, you see this gets a bit different here. And then this is just kind of a cost benefit analysis, or also discounted cash flow analysis, more commonly known. And I did it for the project. So this is just the internal rate of return of the project. Then based on a discount rate, we can discount the future cash flows and get a present value and a net present value based on the initial investment required. And I did the same exact thing for the investors and the owners, if applicable. And then here's just a chart that shows the investors versus owners, cash contributed, and then distributed for each group. So that's distributions. Executive summary is just to show a high level performance result. Instead of looking at the P&L detail and having to go through all this stuff, you might just want to see, revenue and expenses. So here you can see revenue, cost of goods sold, gross profit, EBITDA, all right here. Then I did some other cash flow items, annual EBITDA. Note that the CapEx here includes the CapEx from this. It also includes the CapEx from acquisitions, which is from these. Because you're not going to get these locations for free, most likely. You're going to have to pay for them or build it out. So it has to be accounted for somewhere. So that's that. Debt service, if you have any debt, that's going to come through here. Startup costs, outside of everything else we talked about. Proceeds from the exit, we just removed the exit. If we put it back, you can see that's going to be an item, shows there. Loan proceeds, loan payback. We're assuming on the exit, if there is a loan, whatever the balance is at that exit month, it's going to have to get paid back before we can get to cash flow. And then based on equity contributions, we can see the cash flow each month and the cash position, each year. Now the monthly is going to obviously net to zero. So the minimum is what we're solving for to get our cash requirement. So you can see here, we'll get to zero right there. And that means we have enough cash to cover all the burn and never go below zero. And that's how we're solving for the cash requirement. Then I just did some more summaries here for IRR, equity required, total cash returned, equity multiple, project ROI. And I did that for the, well, this is for the project, investor, and owner. There's also a break-even month and a break-even year and that's basically when the equity is paid back or enough cash has been um, returned to pay back um, the equity requirement, whatever it might be. I put in a ton of visuals. I'm probably actually going to add some more visuals. I want to do the total revenue and or sales by location per month. So this here, I want to put this into a chart, so I'll probably add that in. Um, and let's see, do I have the sales? Oh, I do by tier though, which is kind of hard. So I probably won't do that one, but I can do the monthly revenue by location, and I'll put that on some kind of a combo chart or something. But I just try to include the high level items here. Then you can see kind of cash flow and all the dynamic outputs of the assumptions. I tried to show their effects, like ticket counts, cash flow, active locations, monthly revenue. Then we put monthly labor versus labor count, monthly labor costs versus average pay rate. Um, you can see here I did average pay rate calculation. This was kind of interesting to figure out based on the total hours per month and total labor cost. We can figure out what they're getting paid per hour on average, fully loaded. Um, and that's it for the visuals. P&L monthly and annual is just, they're the same things, but just one's on a monthly basis, one's rolling it up into an annual basis. And I just try to show basically how the assumptions are working over time for every single aspect of the scaling operation here for retail. Uh, so you've got just how revenue is happening, ticket sales, revenue. We talked about how there's two revenues. These are the same. They're not double counted. Then there's cost of goods sold, gross profit, operating costs. Operating costs include labor plus are fixed. Then we've got EBITDA. After that, then you've got depreciation, which you can hard code in or figure that out elsewhere and have it slip into here. You've got EBIT, then EBT, and then taxes based on that rate. If it's a positive, if it has a positive EBT in the P&L annual, it'll do taxes, and it'll split that up based on the active months that exist for that year. Then net earnings. Then we got other cash flow items, so we're adding back in inventory, or we're taking inventory out here. We're adding back in the cost of goods sold, um, debt service, debt balance, debt proceeds, debt repayment, capex, startup costs, exit of business if applicable, and then trailing 12 months. This is just to figure out what 12 months to count when we're doing our multiple, which is this. You can see it's just basically summing up, if this is a 1, summing up all the EBITDA multiplied by the multiple on the control tab. Cash flow before equity, cash position before equity, and then we get this money in. So here's your actually what money you should expect to be in the business's bank account. And you can see it goes to 0. Now that means assuming everything happens as you think, you'll have just enough to make it. If you want a reserve, you can just go into your startup costs and put in a value here. And that's just going to say when you get to 0 here, you'll actually have whatever your reserve is available, whatever it might be. And that will all flow to like your startup, your equity requirements and everything else dynamically. Test schedule's really simple, based on debt proceeds on the control tab and your inputs here, which, oh, these be blue. Um, you can change these, whatever makes sense. You can change the payment date as well. And that's it. All right, so now as far as if you want to actually use this template, I'm selling it. It really should be a $125 one or a 75, but I'm just gonna put it up there for 45 because I really want people to engage with this logic, and I think it's super useful, and there hopefully will be enough volume. So I'm going to sell it for $45. I'm going to list it at obviously at smarthelping.com. I'll also list it on Eloquens and efinancialmodels.com. All right, well, I guess that's about it. Don't forget to check out, I've got new category discounts, bulk discounts by template category at smarthelpme.com. You might be interested in that as well. Um, Also, for this, if you stayed along, listen this long, if you do purchase this template for $45, I will offer a 50% off your next purchase, whatever it is. Obviously, it can't be labor or hours. Like I charge an hourly rate of $120 an hour to do custom work, so that's not applied. But if you buy anything else, it could be a bulk order, it could be a single one, um, could be whatever. I'll give you 50% off. So just email me about it, and I'll get back to you. All right, that's all I got for you. See you on the next one.